All right, guys, it's Paul Singh, the market speculator, with the free weekly swing report at bullsonwallstreet.com. Let's talk about what happened last week, and there was a lot of bad news. Take a look at the indexes here and some industries, and then 5 stocks we're watching to start the first week of October trading, and the last week of September was not good in terms of news and the market. Let's start with the inflation report. Friday, the PCE came in hotter than expected, which is becoming the usual, so maybe we should expect it. Obviously, the market is worried about that because then they know the Fed right here, Fed Reserve watches this level closely. Market obviously is worried now that they might raise interest rates even more than expected again. And as we see here, if we look at SPY's been trading in this range, and it broke down below this range on Friday, down 1.55%. You can see we had that June low here, which was very important because it also corresponded with this range here going back to 2020 post-pandemic. And now, if we head into this week and don't recover quickly, this might be a spot to establish some shorts, and then we would have a target range here at the pre-pandemic high. Hard to believe we've pulled back all the way down close to that level, but that's what we're looking at here. So Friday was not good. SPY down 1.5%, breaking this important range. And then we also had Stanley Druckenmiller, very important, respected person here, saying, and he's usually not prone to hyperbole or these types of statements, saying like that, hard landing in 2023, deeper recession than many expect. So the market takes notice when this guy says something like that. Obviously, we pay attention to price action, not what these guys are saying, but worth noting. But more importantly, these companies here in the consumer cyclical space, very tied to the economy, Nike, Apple, CarMax, Carnival Cruise, and Rite Aid all had very bad news, all warned, all talked about the high US dollar and consumer spending. So this was not good. Let's look at all of these charts here. Nike, Apple, CarMax, Carnival Cruise, and Rite Aid. Let's start with Nike. You can see here, big gap down on earnings, and then they warned. They talked about the US dollar and how that is impacting their business and retail in general. A lot of the footwear stocks got crushed, and a lot of ancillary kind of companies also got caught as well. DKS pulling back, Deck footwear company, which we were actually in, and you can see this thing pulled back hard as well. They don't have any news of their own. This is all because of essentially Nike here, and a lot of other retail companies getting hit as well on this news. Now, Apple also warned production issues are slowing. They're going to slow production. iPhone 14 slowing in terms of consumer spending. Not good. And then so we can see the move down here. And then the next day, a downgrade, which Apple is not used to. Doesn't get downgraded a lot. But analysts downgrade here. And you can see how Apple got crushed last week. And it had actually been holding up pretty well compared to some of the other big tech stocks. But this one got hit hard as well. Now let's look at CarMax, one of the biggest used car companies, auto company here. They did the same thing in terms of warning. You see the huge gap down, 25%. This thing just like a month ago was trading at 106, now all the way down to 66. And then we have Rite Aid as well, big box retail. And you can see here in pharmaceuticals as well. You can see big gap down on, I believe, earnings as well. And then finally, Carnival Cruise, so related to travel here, big gap down on Friday earnings. So you can see here, down 23%. This thing is down to 7. The post-pandemic high here was 31. And even before that, this thing was sitting at around 70. And now it's sitting at 7. So not a good week. And these are important related to all these companies here. Their reactions are important related to the market, consumer cyclicals, retail, consumer spending. These companies are a good clue to that, and all got crushed last week. So that's something to be thinking about here. And then we looked at SPY already. Now let's look at the Qs. Also, down 1.7%, just barely breaking the June range. Actually still above way above its post-pandemic high. And then pre-pandemic high. IWM here still testing the bottom of the range. So maybe small caps are holding up a little better. You can see it was only down 0.73%. So about half of what the bigger indexes did. Semiconductors have been getting crushed, 1.5%. Retail here down 1.5% as well, and breaking this range. No surprise when we see what all these companies here did. Let's go back to the US dollar. US dollar very strong, pulling back a little bit. And when it's pulling back, it's surprising the market didn't pop some. But there's been an inverse relationship. As this thing keeps going higher, the market goes lower. When this thing pulls back, the market tends to run, although that did not happen last week. So something to pay attention to. And let's look at home builders and industrials as well. Home builders down 0.76%, actually above their June range, which is surprising considering all of the bad news that has come out for real estate. But somehow these are showing relative strength here. Still getting crushed, but compared to some other areas, maybe showing some relative strength. And then industrials getting hit as well. And energy, overall, a better chart than some of these others, still kind of in this uptrend. But has pulled back some here, and we'll see if it can remount the moving averages. So that's essentially where we are right now. What all this stuff is telling us is be cautious, be patient. At some point, there will be a good opportunity for longs. We'll wait and see. And in the meantime, we'll watch and see if early next week we have a good opportunity to short now that we are below this range. What I want to see next week is, do we recover quickly or do we continue to start to slide? In that case, we can start to establish big shorts. But if we were potentially looking for longs, let's look at 5 different stocks we'd be watching. Netflix, Twitter, Disney, Yelp, Oxy, all interesting patterns. Let's start with Netflix, which has been beaten down for a while, but looks like it's bottoming here, had very good earnings, ran up to the top of this range here, and has essentially been consolidating ever since. And while the market has essentially been doing this, Netflix has been kind of range bound here and not sliding, actually holding up. And that's what we want to see right now. What companies are holding up? Netflix is one, which is weird because if you look at the overall pattern, crushed. But more recently, and when I say recently, I mean over the last 5-6 months, actually has held up well and better than the market. So we're paying attention to this one. Another one is Twitter, also has held up well. Had all the Elon kind of controversy here, but has held up well overall, above 50 and 200-day moving averages. Not many stocks can say that. And on top of that, the 50 is actually above the 200-day moving average. And again, not many stocks can say that as well, especially let's just quickly look at the big tech. And what we'll see is, I don't think any of them are doing that. 50 below the 200, price action below both. You're going to see that on all of these stocks here. The only one that is not doing that is maybe Netflix as well. We have that in our big tech. And that's above the 50-day moving average, which is still below the 200 though. But Twitter is actually in kind of uptrend moving averages. These things just have to need to start curling up. But overall, pattern pretty good here. Now we have Disney. Disney is really beaten down. So very oversold, but it did have really good earnings. This was the earnings reaction. So maybe we get a rubber band bounce here. We'll see. Not something to jump into right now, but we'll wait and see if it were to give us a signal. And Yelp had very good earnings and is holding up well after a pullback, holding its 50, holding its 200. Another one where the 50 is over the 200 now, which again is rare in this market. You can see the big earnings breakout, pullback. Now, maybe this is going to be an opportunity here if the market cooperates. And finally, Oxy. We all know one of Warren Buffett's favorites right now. He's been building a position in here for a while, and he keeps adding to it. And you can see here, overall, very nice pattern. And again, 50 above the 200. This one's an energy. And if this could remount to 50-day moving average, would potentially have a very nice pattern. So that's it for the weekly swing. Of course, you can join us on Bulls on Wall Street. If not, I will see you guys next week.